Thank you for watching another video brought to you by Behavioral Wealth Consulting channel, where my goal is to help you change your behavioral decisions by improving your financial literacy. But before we get started, just a reminder that I'm not a financial advisor or tax consultant. This video is for informational use only and not intended for financial, tax, or investment advice. Always consult with your own financial advisor or tax advisor before making any financial decisions based on your personal situation. Okay, so maybe you've been thinking about getting into the stock market because of the recent social media attention around the economy improving. Maybe some of your friends recently got into trading, some of the new apps such as Robinhood or Webull, or maybe you've just reached a point where you're ready to invest in your future. Regardless of the reason, there's never been a better time to start investing than the day that you start. But before you throw your hard-earned money into the stock market, watch the rest of this video to educate yourself on some things to consider before getting started. And if you find this video helpful, I'd appreciate you hitting the like button and subscribing to my channel. So once you start educating yourself more on the economy, it's likely you'll come across some videos, articles, or conversations about the next stock market crash. The stock market historically has shown a crash or downward trend about every 5 to 10 years. And if you're not currently investing, you may not even have paid much attention to the last several events that disrupted our economy. Prior to the second quarter of 2020, when the pandemic attention seemed to be at its most uncertainty, this caused a lot of investors to panic sell everything from their 401k, retirement accounts, and individual portfolios. And prior to 2020, the last stock market crash was in 2008 during the housing market crisis. Both events drove down the prices anywhere from 20 to 60% in just a matter of weeks. And crashes are typically caused by panic, companies being overvalued, or a sudden drop in the economy. And the results of these types of crashes typically can create about a 1 or 2 year recovery in a volatile market. When you understand what drives the overall share prices down, it presents a lot of good buying potential for those who are ready to get in. Having investable income on hand and sitting within your broker account, for example, will position you early for some good buying opportunities for those companies that you've been wanting to invest in. If you're just getting started, you may want to research companies that follow the major US indexes such as the S&P 500, the NASDAQ, or the Dow Jones. And if you're unsure what those are, I will be posting another video covering that on my channel. And in 2009, for example, McDonald's share price dropped about 15% compared to 50% drop of the S&P 500. However, since then, McDonald's has been up about 200%. So focusing on companies that have historically lasted through the bear markets or downward trends could be a consideration in your diversified portfolio. Dollar cost averaging is an effective way to reduce the impact of share prices going up and down over time by ensuring you're watching your entry price points whenever you add more stocks to your portfolio. Since you can't time the market for only when prices will be low, dollar cost averaging is a good strategy to continue to grow your portfolio by buying a small amount of shares over an extended period of time, so your price point for your shares averages out in the long term. This may result in less profit when the economy is doing well, but it can also mean less risk to your overall portfolio. And so remember that investing is a long-term strategy. So when thinking about what kind of investment portfolio you want to focus on, consider diversifying in individual companies along with mutual funds or ETFs that follow a specific sector that you're interested in, such as technology or maybe travel and entertainment. Make sure to research the types of companies that match your investment goals. Growth stock companies can be found in small, mid, or large cap sectors. They are covered or considered to have a good chance of considerable growth over the next few years. Some of those growth companies that you may know are companies like PayPal, Amazon, and DocuSign. While value stock companies are usually larger, more well-established companies that are trading below the price that analysts feel their stock is worth, depending upon the financial ratio or benchmark it's being compared to. Value stock companies would be companies like Verizon, Apple, or Microsoft. So that's it for today's video. I hope you've learned something new that improved your financial literacy. If you'd like to stay connected to more videos like this, please click that like button and subscribe to my channel. It helps the content to get out to more people who can benefit from this information. Thanks for watching.